3, 2, 1.
In this video, you are about to witness some powerful and mind-blowing perspectives on investing. Motilal Oswal Wealth Management presents Vantage Point Masterclass series with leaders, writers, experts to share their perspective on what's happening around.
This webinar had ultra-special guest talking about his investing journey, exploring ways people think about money and how to make better sense of most important commodity, through his bestseller book, The Psychology of Money.
Mr. Morgan Housel is a partner at the Collaborative Fund, a venture capital firm, investing in young companies that will make an impact in the world. Winner of several accolades for his writing culminated in the book, The Psychology of Money.
Let's understand from the story that made a big impact on his investing career.
Meet Ronald. He was a philanthropist, investor, janitor, and gas station attendant. He fixed cars at a gas station for 25 years and swept floors for 17 years. He died at the age of 92, and left $2 million to his stepkids and more than $6 million to his local hospital and library. This astonished everyone.
Meet the second character, Richard. He was a Harvard-educated Merrill Lynch executive with an MBA. He had a successful career in finance and he retired in his 40s to become a philanthropist. However, he lived a very lavish lifestyle, and unfortunately, when recession struck, he was completely bankrupt.
So what Morgan found interesting was how someone with no formal education, no background, no experience vastly outperforms some with best of the world. And, this happens only in the world of investing. Hence, he wanted to explore why people do the things that they did.
According to Morgan, investing is primarily a study of how people think and behave with money. It is a story about the relationship between greed and fear, and your ability to take a long-term mindset. How gullible an investor is, who do you trust and who you seek your information from.
So, how does one become better investors? How should we think about risk, and our own financial goals in a more practical way? Let's hear two fascinating stories to help us understand better.
The first story emphasizes that in investing, timing is meaningless, but time is everything.
Story has to do with ice ages. Again, nothing to do with investing, but this will all tie back to a very important investing point. We have known that 5 separate times during our planet's history that the planet has frozen solid. There's been an ice age where the entire planet Earth turns into a giant ball of ice. We've known this for centuries, that this has taken place. We've also known for many centuries that the reason this takes place is because the world's axis tilts closer and further away from the sun. That creates these ice ages, these giant climate changes. Now, for centuries, it was assumed from climatologists who study these that the actual cause of ice age, the dynamic that got this process going, was brutally cold winters during these climate change periods. Winters would become so cold, so snowy all over the world that the entire world would freeze. It wasn't until about a century ago that a group of climatologists in Serbia realized that that was not actually what was causing ice ages. It was actually the opposite. What was causing ice ages was actually this. You would start with a cool summer where the winter snow would not melt. That was the trigger that got this going. Because what would happen is after the cool summer, if the snow did not melt, it would stick around for the next winter. And then there was a larger base of snow next winter, which let more snow accumulate that next winter. So when there's more winter snow accumulation, then there is less summer snow melt the following summer. And then you get this cycle, around and around it goes. You start with a cool summer where the winter snow doesn't melt, and then it just starts layering on top of each other. It starts compounding. Now, it is not intuitive at all to think that you could start with the normal planet Earth, and then you have a cool summer, and then the next thing, tens of thousands of years later, the entire Earth is covered in ice. That is not an intuitive thing to think about, but that is how compounding works. Compounding, even if you understand the math behind it, even if you are a smart person, the intuition of compounding is not obvious to grasp because it is not intuitive to think that a very small, seemingly meaningless change can have such a profound impact on your outcomes. And that, of course, is also true in investing. Let me show you what I mean by telling you a story about Warren Buffett, the most successful investor of all time, one of the richest men in the world, of course. This is Warren Buffett's net worth by his age, by how old he was, going back to age 14 when he first started really saving money. And two things I think should stick out from this chart that are really important to our story about compounding. One is that Buffett was pretty wealthy when he was young. By the time he was in his early 30s, he was already a millionaire, which if you adjust it for inflation is more than $10 million in his early 30s. So he started young. He started investing at age 11, and he was consistently doing it so that by the time he was in his 20s and 30s, he was already very wealthy. The other thing that should stick out is that the vast majority of Warren Buffett's net worth came in his elderly years. By the time he was 80, or let's say by the time he was 70, he was worth about $15 billion. And now by the time he's 90, he's worth about $90 billion. More than 96% of Warren Buffett's net worth came after his 50th birthday. More than 90% came after his 60th birthday. Now, again, what's so interesting about this is that Buffett started investing at age 10 or 11, and he continues to go through age 90. Now, let's do a little thought experiment to think about a hypothetical world in which that was not the case. Let's assume that Warren Buffett started investing when he was 25 years old. And let's assume that he retired when he was 65 years old, like an average normal person. And let's assume that he earned the same average annual returns during that period. He was just as successful, just as talented an investor as he has been. But let's assume he started investing at age 25 and he retired at age 65. What would his net worth be today if that were the case? The answer might shock you. It's not 90 billion as it is today. It's about 12 million. 99.9% less if he had just started investing a little bit later and he retired at a normal age. The takeaway from this is that we can tie mathematically 99.9% of Warren Buffett's net worth to the amount of time he has been investing for. Not his investing returns, just his time. Of course, Warren Buffett is a very talented investor. His skill is investing, but his secret that has made him a household name is time. If Buffett started investing at 25 and retired at 65, you would have never heard of him. No one would have ever heard of him. He would have been a wealthy guy who may be playing golf right now, but he would not become the investor he is. Now, what's so important about this, that gets back to investing, to compounding not being intuitive, is that if you go on Amazon.com, there are 2,000 books that are in some way devoted to answering the question, how did Warren Buffett become as successful as he is? And they go into great depth and great detail about how he thinks about moats, how he thinks about business models, how he thinks about market volatility and economic cycles. Very few of them will point out just the fact that we know the answer of why he's become successful. It's just the amount of time he's been investing for. That is his secret.
So the key takeaway from two stories to improve your wealth and returns is to lengthen the amount of time you are investing so much so that it comes down to your time horizon.
How do you understand and manage risk in investing?
About 100 years ago, there was a famous magician Harry Houdini known for his escape acts. But he had yet another trick that the audience loved. So, in this act, he called the strongest man in the audience and asked him to hit as hard as possible and it would not hurt him.
In 1920, when Harry was in the dressing room, few students came to meet him. One of them out of curiosity hit him very hard in the stomach. He didn't mean any harm, but he was just performing the trick that Harry often did.
Little did he know that this punches will rupture the appendix and eventually kill him. A day before, Harry stated that if at all he knew the intention, he would have been prepared for the blows. According to Morgan, the riskiest stuff is always in what you don't see coming.
So, who or what is the biggest risk? Is the trade war between China and the US, the upcoming elections, or is COVID the biggest risk? It is no doubt COVID, because no one saw it coming. If you look historically, the events which didn't move the needle were the one which was talked about, analyzed, and not the one unanticipated.
So what should an investor do? How do you live in a world in which the biggest risk is the thing that we are not talking about?
The residents of California are immune to earthquakes. Hence they are always prepared to deal it with. They have plans and preparations at any given time. So think about risk in the same way. Having an expectation rather than a forecast is the right way to think about risk and the economy.
Second part of risk is understanding the difference between getting rich and staying rich. Getting rich requires taking a lot of risk, being really optimistic about the future. But staying rich requires pessimism, endurance to survive and sticking around. So save money like a pessimist and invest money like an optimist.
So as an investor, we do not need to think about investing through an analytical lens of chart, formulas and data. They are important but not essential. Important is to have a better understanding of the psychological side of investing.
One can be a smart economist, an astute mathematician. But if you lose your mantle in crisis, or when economy is falling apart, none of it matters. So having a psychological side is important as it has the ability to neutralize the analytical side of investing that we tend to spend so much time focusing on.
Moving on to the question and answer round.
On being asked, how does one plan to fail? He mentioned that the first step is to accept and understand that there is no certainties in the world. The best we can do is try to put the odds of success in our failure and realize that there is a certainty that at times things will work against us.
He also mentioned that if you have a 90% chance of success in doing something in life, then by definition, you're going to be wrong 10% of the time. In investing world, it means that if you're a stock picker, you are right 60% of the time.
One very powerful concept he mentioned was the history of illusion, which basically says that people are aware of how much they have changed in the past, but they don't think they're going to change that much in the future. And for financial planning, this is really important because if you are an extreme saver or extreme spender, you need to push towards a modest, median and balanced financial approach.
Next, we was asked about how important is intergenerational wealth transfer. He mentioned, everyone has different goals, aspirations, hence there is no size-fits-all advice. But it is important for the transfer to happen in the early age, so there is lesser risk, more mistakes and eventually more learning.
On being asked, how different investors like different asset classes, he mentioned we all have different experiences, and all anyone does when they are thinking about the future is they take the mental model basis their past experiences and then they think about future.
How does one prepare for unannounced risk? He mentioned that the world breaks in a very meaningful way about once per decade. If you just include that as your baseline expectation for what's going to happen in the future, then it prepares you towards more room for error, a higher savings rate, less desire for debt.
So if you just assume that there's going to be constant chain of problems once in a year, in personal and in the economy, but it is short-lived and does not preclude long-term growth. Also, second thing is you do not need a reason to save money.
On being asked, any particular trends to see in future? Morgan replied, COVID-19 has divided people into two categories. 1. People who have ability to work from home, heavily dependent on money made, education level. But poor people who do manual work are still struggling. They are either been laid off or have started slow. Second thing is expectations and reforms from government, as it will have a direct impact on the voting bank.
On being asked, what is top biases an investor has? Morgan mentioned, most important bias is assuming one can overcome biases. You have to embrace it, accept it, and have an investment philosophy that will not break you. So introspect about yourself, that is where you will get all answers.
So, to recap, the key takeaway is investing is not just a study of data and charts, it is about how people behave with money, one's ability to take a long-term mindset.
The single best thing that you can do to improve your financial performance, to improve your wealth and your returns, is to lengthen the amount of time you are investing, for so much of investing just comes down to your time horizon.
To manage risk, have an expectation of a major event, rather than forecasting the event, just like people in California expect earthquake. Know that world has 2 or 3 major events per decade, so keep that as baseline expectation and it will keep you prepared.
Lastly, investing strategy doesn't rely on picking the right sector, or timing the next recession. It relies on a high savings rate, patience, and optimism that the global economy will create value over the next several decades. Every investor should pick a strategy that has the highest odds of successfully meeting their goals. Wow, wasn't that a complete change of perspectives? We thank you for listening to us and always trusting us. We also thank Mr. Morgan Housel for his brilliant 70 minutes discussion.
There are more such insights in the Word document sent to you. In case you haven't received it, please write back to us on privatewealth@motilealazwal.com or contact your relationship manager.